Hey, what's up everybody? Zach is back with another video. And today I wanted to go over some confusion apparently about my watch list, and I wanted to just touch on that to maybe clear it up for you guys and explain more of what I'm thinking. And also I wanted to go over the keys to building a successful and conservative portfolio. So, about the watch list, the watch list for me is just my thoughts on just really what I'm thinking at the moment, and it's mostly for swing trades. It's not going to be the buy and hold long term. Why? Because I have a time frame. So clearly, you see what I'm thinking of the what the target price I think would be, what entry price, maybe we can buy at the support. Usually that's what I would do if it drops down a little bit. And also the different risk levels and the time frame. So the time frame is is about when the price would get to my target price. And the entry is obviously what I want to enter it at, and risk level 1 being the less risky and 5 being the most risky. I think that's pretty self-explanatory, but this is not really for buy and hold long term because of the time frame. So really this is swing trading. Now, one question is, are we going to be doing options or commons? That's really going to be up to you, because number one, I'm not telling anyone what to buy, when to buy, and how much to buy it for. These are decisions that you need to make by yourself. But I am giving you an insight into my thinking, my thought process, what I'm thinking about currently, and just my personal watch list. Now, just because the stock is on my watch list doesn't mean that I have a position on every single one of these. All the watch list is means that I am watching these stocks more than I would be some other stocks. So I'm really waiting for an entry to get a position on the ones that are on my watch list. So the goal of the watch list is for, well, like I said, to give an insight into what I'm thinking, to let you see which ones that I'm trying to get a position in, and also a starting point for you guys to do your own due diligence. And that goes along with the reports as well. So, for example, I'm posting the write-ups on prostockadvice.com/blog, and I'm posting them to Reddit and some other places too. But really, those are my opinions. That's my thought process. That's my due diligence, and I think that's a starting point for everyone else to go out and to do their own due diligence, to do their own fundamental analysis, and also because I post the pictures of the graphs with the supports and the targets and the cut and the buy zone. And those are my technical analysis, but you guys can do your own. So this is just giving you guys a starting point. Now, that's from the watch list. Now, obviously, there's some beginners that would just like to coattail or piggyback off of my trades, which is totally cool. But that's all up to you. You can trade what I'm trading. You don't have to trade what I'm trading. It doesn't matter. But the point is, if you want to do specifically like, okay, I'm buying this one from, just give you an example of the new one on my watch list, NET. So maybe the market opens up on Tuesday. I'm thinking I'm going to be watching this one, right? Because it's on my watch list, and I want an entry at around $85. So let's just see if we're going to get that. The market opens up on Tuesday, because today is President's Day. And I'm watching that, and maybe I get a position maybe I'm selling a put at $86, and that forces my cost basis to be lower to 85, just for example. So that's specifically what I'm doing. I'm selling a put. My strike is this. My expiration date is this. So if you want to know the specifics of what I'm actually doing when I execute the trades and when I'm executing the trades, that's for more of the Twitter. Go follow me on Twitter, link in the description, and that's going to be, you're actually seeing what I'm really doing and exactly how I'm executing and when I'm executing and for what contract size. Or if I'm holding the comments, because look, some of these I'm not going to be doing options on, like some of the SPACs. They don't even have options yet, but it just depends. Also, if it's, I might be selling a put, so then I get assigned, I might actually end up with 100 comments. So don't take the watch list as a very specific guideline. It's very general, I mean, and it's just my thoughts of my opinions on these interesting ones these interesting stocks that I find interesting at the time. And the watch list is always getting updated, and sometimes I take some off the watch list if I don't really want to watch them anymore. And really, it's trying to find a position. Of course, I will watch a bunch of different stocks, but these are the ones I'm specifically looking to get into. But yeah, I mean, some can be comments, because I know that was one of the questions. Some can be options, some I'm running the wheel on. I mean, it really just depends. So again, if you guys want to know exactly what I'm trading, maybe you want to coattail off of my trades, maybe you want to piggyback, and that's up to you. I don't necessarily recommend doing that, but I just want to be all out in the open on the Twitter. So follow me on Twitter, and then you can see exactly what I'm doing. But yeah, watch list is just very generalized. And I think that's pretty much can wrap it up. I mean, if you have any more questions, let me know. I think that pretty much should explain to everybody what's going on with this watch list. These are not trades I'm doing, obviously, because there's no strike prices, there's no expiration dates, although there are entries and time frames. But nevertheless, I think you guys get the point. Go on the Twitter, follow me there. You'll see a lot more detailed trades going on there. Watch list is just general idea, place for you guys to start your own due diligence process. Anyways, let me go ahead and change gears, shift and talk about how to pick and set up a nice portfolio and how to allocate your cash the right way, in my opinion. So what I've always done is like this. I have 90% of my entire portfolio is long-term buy and holds. That's going to be the bread and the butter. That's going to provide you the safest for the long-term growth. So I will highly recommend doing that with most of your portfolio. The other 10% we can play with options, just to create some extra income. And I always like to think about it as my salary that I'm doing for trading and doing all the research on. I'm getting paid for this. I'm using, I think, around at any time, probably right now, let me just go ahead and pull this up on my Webull. I have it open. So, yeah. So let's see, go into this right here. I think my options positions, currently it's only 15,000. So it's not even, yep. It's about 15,000. I need to calculate that and make sure that's right, but I'm pretty sure that would be accurate. But nevertheless, it's only 15,000, and that's over, what's the math on that? 15,000 for my options. And this is currently, of course, it's going to fluctuate depending on the positions I'm in and out of at any given time. But just to give you guys a rough estimate, that seems to be about 2% of my portfolio right now. And of course, I definitely plan on doing more than that. But the point is, I would recommend around 10 to 20%, and it depends on your risk tolerance. 10 to 20% allocate towards options, and the rest, vast majority, in long-term holds. So first of all, let's talk about the money allocated towards options. For me personally, I take a more conservative approach because my first goal is protecting my money, and I'm not trying to lose money here. All right, I would prefer to make no money than lose money. And it's worked out pretty well for me so far. So this is what I do. For my options, I have half of the money I'm running wheel strategies. All right, I'm making the theta plays, I'm selling the puts, I'm selling covered calls, I'm just collecting these premiums. And that's the safest thing when as far as options are concerned. That's the safest thing that you can be doing, is running a wheel. After all, that is what level 1 options is. And so that's about half of the money for options. I would do a wheel strategy. I'd probably do 30%. Maybe long-term, maybe 10 months plus option contracts, and then the rest, maybe 10-20%, I would do like midterm or less, like shorter midterm, to try to get those 200-500%. But I'm always taking the profits 25, 50, 100%, and then I'll let one ride until closer to expiration to try to get that 200+%. And if it goes to zero, it doesn't matter because I've taken the profit at 25, 50, and 100. But that's the basic thought on the short term. So let me say it one more time to make it clear. 50% I put in a wheel strategy. 30% I would recommend doing long-term options, and that's including leaps. And then 10 or 20% I would do short-term options. All right, so If you have a small account balance, this can be totally different for you, because if you only have $5,000 and you have 90% in long-term holds, that only leaves you like $500 to play with options. And then half of that needs to be a wheel. So obviously that's not going to work. So I mean, if you have a small account balance, probably, I don't know, I'll probably say $20,000 or less, I would probably recommend, instead of the long-term holds at 90%, I would probably do something smaller than that, and also consider leaps just to get the cheaper exposure. So leaps, I mean, a leap option is anything over 12 months to expiration, and if you can get a deep in the money leaps, deep in the money call, I mean, you could get a delta like 80, 85, then you're just going to get really cheap exposure to the underlying. So let's go ahead and look at that. So here is here is an Apple. Let's just use Apple for example. 85 strike. This is about an 85 delta, and this is a year and a half out. So let's just pull up our calculator. Now this is going to usually cost us, let me do the math on this, 85 shares, because we have 85 delta, so that's 85 exposure to 85 shares. So 85 times 135, 85 times 135 market price, about. That would usually cost us for 85 shares of exposure to 85 shares, would usually cost us almost $11,500. Now, if we see what the price is for this sleep contract, it's only $54.60 right here. So it's about half the price. So my point is, but it's got an 85 delta, so it's still going to give you the same exposure. It's going to act very similarly if you were just holding 85 shares. So that's the point of the leaps. And I mean, if you have the low account balance, I would recommend maybe more in that, because you're just going to get just more in leaps, because that you're just going to get cheaper exposure. That's the point. So you're still going to go long-term holds, but instead of just doing just buying the common shares, then you could get the leaps just to get a cheaper exposure, so you can really use your money in the right way, saving money, and then you can further diversify and use it get into other positions as well. So that's what I would recommend for the people with lower account balances. Instead of 90% buy and hold, I mean, you know, it's a lot safer to do that. So once you build up your account balance, I would consider that. But there's nothing wrong with getting into leaps, just for that cheap exposure. Well, and then the next thing I would like to talk about is about what my long-term buy and holds are and what I would recommend doing. So for me, I'm really into ETFs, because the point for myself is the diversification. That's the number one goal for my long-term holds. It's a lot better being diversified instead of putting all your apples in one basket. So the best way to do that is ETFs. So what I've done personally, and now before I get into this, I will let you know that I go through this and I've rebalanced a couple times a year, and I switch some of the bad performing ones over to some better performing ones. So it's not always just going to be the same. I'm not always just going to leave this until I'm 50 years old and then, see, although I do refer to it as kind of like my retirement. But nevertheless, I mean, the ETFs, I mean, so what I did is get just a good old NASDAQ ETF, like QQQ, got an S&P 500 ETF, got the Dow Jones ETF. I've taken some 3X ETFs, leveraged the TQQQ, SPXL, UDOW, UDOW, just to get a very, very, very broad diversification across the entire stock market, the entire American stock market at least. So I think that's the most interesting for me, and it's done really, really, really well. I cannot complain. And then specific sectors that I've gotten ETFs in would be just technology, like let's see, for example, I'll go ahead and pull this up for you guys. So here is a Vanguard, the information technology ETF. So this is just going to be extra exposure into the tech sector, And also semiconductors I usually like SMH. I actually have an options contract on that right now. Or SOXX is the same thing as SMH. This is just managed by VanEck Vectors Semiconductor ETF. But yeah, so this is the semiconductors. I would be into the just any broad like tech ETF. You could try a clean energy ETF like ICLN, but anything like that that you think is going to have really good growth and over the long term. Because these are the ones that we're just going to buy and hold and kind of forget about. But basically, that is what I would do. So really, to go over this one more time, I would like to say diversify into ETFs. Those are your friends. Don't worry about picking the specific ones so much, which is a little bit more risky, but it could play out. Like, for example, I have some Tesla that I'm in. I have some ARK K, ARK G, ARK W, ARK F, all of the ARKs I would like to just get a little bit of. Although the way I weighted is, well, when I first started, I put the equal amount of money into every single one. And then just over a year see how they performed, and then I rebalance it. I think that would probably be the best way to go about it. Although you could put more into the like the NASDAQ, Dow Jones, and S&P ETFs, just because those would have the biggest, the best diversification. But nevertheless, you can take some just single company stocks and run with them long term. I have with Tesla, but there's no need to do that because ARK K, the ETF, it has Tesla inside of it, so there's really no need to do that anyways. But that's my recommendation. Specifically, I will show you what specifically I have in my long-term hold portfolio. But remember, on my Twitter, I'm posting these things. So I don't know if you're following every single tweet that I'm doing, which probably not, but that's unrealistic. But if you are paying attention, you will see sometimes, like recently I picked up some more ARK Invest ETFs for my long-term holds. You know, I don't remember, it was like 30, 40 shares of something, one of the ARK. But I recently had done that. So if you are paying attention, then I'm not only doing options, but obviously majority of my posts are about options because those are day trading or swing trading. The long-term holds, I'm not going to be posting about those every single day because I'm not going to sell them. I'm going to just keep them. But they do make it into my Twitter feed eventually because there are some points that we need to pick those up. But then remember, guys, it's not all about options because even with that said, I'm only doing maximum I would do is 10% of options anyways. Of course, you can have long-term holds and you can sell covered calls against them. It is possible. But just be prepared to get assigned and have to sell your shares and maybe pay some taxes on it. Maybe not really worth it, actually. So for me, I don't do that. I have specific stocks in my options portfolio that I am totally okay if I get assigned and have to sell them. I'm not going to pay any tax anyways, but I mean, if you ask me, like, take a chance on like some of my semiconductor ETFs that I've been holding or my QQQ I've been holding for a long time, and I'd take a huge hit on the taxes. So no thanks. I don't even want to risk the couple $100 in selling covered calls for that. But, it's up to you. So for me personally, I have my, like, for example, Solo, ACTC, GEVO, or whatever I'm running the wheel on. Then I have those that I am ready to sell, and I don't mind getting assigned because I haven't had much capital gains on it, just from the appreciation during this wheel strategy that I'm running. So I'm not going to be just really hurt by those taxes. But with that said, let me just go ahead and show you the my buy and hold portfolio. So guys, here it is, and this is going to be a little confusing because this is in my what's it called? The options are in here too. So let me just make it more clear. Okay, so here are the 3x leverage ones that I really like. UDOW is Dow Jones, SPXL is S&P 500, UPRO is, it's either Dow or S&P. Yeah, it's S&P 500, sorry. And then let's see what else. TECL, that's the technology 3X. TQQQ, that's NASDAQ 3X. I'm not doing this one, by the way. That's not in my long-term hold. portfolio, and then SOXL is the 3X semiconductor ETF. Now, I also am watching just the normal 1X versions of all of these as well, and they used to be more in my portfolio, but I consolidated and I sold off a lot of those positions. And I'll tell you why, because don't let anybody tell you that this is too risky and it's going to, the leveraged ETFs are way too risky. It's not good for long term. I disagree with that. Maybe you guys have your own opinions, and let me know in the comment section. And while you're down there, go ahead and like this video. But my opinion is it's okay, because these are it's the S&P 500. If you think that we're about to hit a recession, or you think the markets are about to crash, then obviously it's not a good idea to be in a 3X ETF. It probably isn't a good idea to be in anything, but we can always hedge. But I mean, my point is, these you do have to be careful. It goes up by 3X, but it also is going to go down by 3X. So you really have to be comfortable with having a negative 10% day. Which I actually had not too long ago. Was down like 100,000. It was a couple weeks ago. $100,000, and mostly because I had those 3X ETFs. Now, for me, being in crypto since 2011, this doesn't bother me a lot. Seeing like a -5, -10% day every couple of months, like that doesn't really bother me because I'm used to huge swings. But maybe you guys think differently. But overall, it's been really well. So let's just look at the SOXL. This is my favorite one. It's done the best. So as we can see here, that was the dip I was talking about. So it dipped pretty hard, but it's already back up. So I mean, you got to think about it, guys, because let's just say the normal market, or the normal ETF, so this one would be SOXX. So let's just say SOXX goes down by 2% one day. So this 3X one is going to go down by 6% that day. So it's going to have to come up a lot more when it goes down than the than the normal one. So there's some sort of decay that you should consider. But that's kind of obvious. So let's look at the SOXX. So as you can see, the dip was not that bad compared to the SOXL, and we saw it come up in all the way back, recovered 2 days ago almost at the beginning of the 2-day period, right? Because that was the top from here. So let's just do a rough estimate there, okay? So like in the middle of the day. So now let's check out the SOXL. So at the top, yep. So it took literally, so that was actually towards the end of that trading day. And that was what, Thursday, I guess, right? February 11th. So it took a little bit longer to recover from that dip, but nothing crazy, nothing significant. And then it's just going to experience just more growth, because if the SOXX goes up by 2%, this one's going to go up by 6%. And I've seen some days where this one goes up 10%. So probably one of those days. But anyway, so I don't see any problem with that, because overall this has performed very well since the March lows. You can see that's the SOXL, and then the SOXX. And of course there were dips in there, guys. It's not like there was 1, 2, and then the one we just had 3 big dips, which that one we called if you guys were paying attention for the warning that I had issued. So we kind of knew it was coming, But nevertheless, there was 1, 2, 3 big ones at least. There was some other smaller ones. And this is the SOXX. Now I want to go ahead and change the chart settings over to the percentage. So let's just do this by let's try to get the beginning of the chart right on the dip from the coronavirus. So this was right, and this is XOXX is up 132% almost, let's just say. 132% since the March lows. Okay. So let's go to SOXL. 132%, remember that. And then SOXL was up 785% since the March lows. So you guys can think about it by yourself and let me know. And you can do exactly what I did on the TQQQ, the S&P, SPXL, all those 3x leverage ones. But for me, they've always worked out. I mean, if you believe in the long-term growth of the stock market, there's no reason why you shouldn't get into the 3x ones. Now, if you're unsure, then don't go so big into it. Look, you can take some as the 1x ones and some as the 3x ones. You don't have to go all in. But that's just my basic thought. So let's just go ahead and wrap up the conversation about the 3x and move on. What else is in my watch list? Okay, so the ones I'm looking at for ETF wise, I would like to add the ICLN and the PRNT in, but currently I sold off my Dow Jones, S&P 500, and QQQ when I moved over from Robinhood a couple of months ago. But I do have ARKQ, I have ARKF, ARKG, ARKK, and ARKW. All of the ARK ones are good. I currently have some THCX, but I'm running a wheel on, so technically that's not long-term holds. I might also be thinking about adding the LIT in. I think all of those, which is a lithium ETF, if you guys don't know. But nevertheless, that's how it is. It's just ARK into the also like SMH, but I have an option on that. But anyways, for my long-term ones, it's going to be the ARK K, G, W, F, pretty much like that. And then in my REITs, which are the real estate trusts, I have O, which is this is the only dividend stock that I'm anywhere like interested in, because I'm also into real estate, commercial real estate, residential. I have some rental properties, and I think usually like I'll make some money in the stock market. I'll divest some gains into, and I'll invest it into real estate, because I think that's also an interesting thing we can do. And this O specifically is a it's called Realty Income, and I think I read it was like over like 70 something years they've always increased the dividends. They've never like not paid dividends. They've never been late. They have such a good track record when it comes to dividends, and they always increase. So this is a really good one to be in. The dividend is like almost 5% now. I think it's like 4 something, but it's almost 5%, and it's always increasing. So I just figured like, well, I can always divest some into real estate, but at the same time, real estate is like active, like you have to actively manage those things. So it's also easier to just do this. And I mean, and they pay the dividends once a month. So it's just like if you're collecting rent or something, if you had like an apartment complex or something and you're collecting the rent on it. So it's like once a month. But keep in mind you're only going to make 4%. Now, of course, if the Realty Income ticker O, right now it's like $62, but if it goes up to like $70 every year, it goes up like 8%, 5%. If it appreciates a little bit, I mean, that's also, you could consider that as you're making money, right? Not just the 4.5% from the dividends. But don't count on it though, because it's trading pretty flat. But I mean, if we look at historical chart, we go over the week, it usually goes up, guys. I mean, sometimes it's down, sometimes it's up. It's just like that. And that was a 2008 crash. So yeah. I mean, overall, so my thoughts on this one is I just those extra money I have, I don't throw too much right now because I'm not that old, but this is something I'm interested for preparing for my retirement, just because such a good track record they have and the decent dividends and the decent growth that they have. So if we get 4.5% from the dividends and then maybe 5 to 8 per year on the appreciation, I mean, it's interesting. It's around 12% we could do. And if you have a rental property, and if you know anything about real estate, that's pretty good though. But of course, we cannot count on the appreciation, although I think maybe we can, but some years it's down obviously. But at least we can count on the 4.5% dividends, and every single year it increases a little bit anyways. And you're gonna get paid every month. So basically I just throw some money in here and I don't have to actively manage real estate investments. I think it's interesting. I think my latest real estate investment I got going was probably only going to do about 8% cap per year. So I mean, it is what it is though. So I think this is going to be good overall. Okay, moving on. Crypto, I guess you could say I have some crypto long term, but I actively trade some of those. Let me see if I missed anything. Tackle, TQQ, Tesla. Yeah, that's right. I do have the Tesla. ARCs. Some of these, if you see the quantity is really low, this is just just some free stocks I got from Webull. Appreciate that, guys, for using my link. That's almost the only way you can support me right now, since I'm doing all this for free. So go ahead, if you don't have a Webull, hit up that link in the description and get some free stocks, and that will really help me out. And while you're down there, smash the like button. But anyways, that's pretty much it right now. There's the O. Those are my long-term buy and holds. But anyways, guys, it's always like a couple times a year I'll rebalance it. You know, it's not always going to be like this. You know, you can change it up a little bit. I used to have more of the 1X of all those ETFs, like just Triple Q and SPY, DIA. I used to have more of those, but I sold those off. I was raising capital for some other things, so I had sold those off. But yeah, I might get back into those. And you know what? The strategy would be, we're experiencing growth. I think we have probably a year left in this bull cycle, because now that just all of these retail investors are coming in full force, I think that typically would indicate mid to late stage of the bull cycle. So I think we still probably have a good year left. But anyways, I mean, once we're getting closer to a correction, like a big correction, I'm not talking about like 3 to 5%, because I just had one of those. I was down $100,000 just a couple weeks ago. So I mean, I'm not talking about that. I'm talking about a significant one, which is usually cyclical in every about 10 years. But once we come up on those, then for sure I'll be switching things around, you know. But nevertheless, that it is what it is. I think it's been good for what I've been doing. I keep 90% at least in the long-term holds, because it's making a lot of money. You guys are following along. You know, my portfolio can be up like $30,000 in a day. I mean, and for sure I'm actively trading the options, but currently I'm only using 2% of my portfolio to trade options. But I know I have a higher account balance. So if you guys, like I said in the beginning of the video, if you guys have a lower account balance, think about the leaps. Think about wheel strategy. Think about all those things that you can really get the best bang for your buck and make the most money with the least amount of money. But for me, I'm only doing 2%. I'm still probably making, I mean, what's my Excel? I keep track on all this on the master list on the Excel. Let me just pull that up right now and look at it. But usually on my blogs, I'll have that posted. But I think right now, yeah, I'm up about $4,800 since January 27th. So what's that? Like 2.5 weeks. I think I'm up $4,800, and I'm only using, what did my Weeble say before? 15,000 in options. So I mean, you guys can do the math on that. Actually, I'm interested. Let me do the math too. So I'm up $4,800, and currently I only have open about 15,000 of options. So that's 32% in 2 weeks. But I'm pretty sure I just had closed some out, so it might be a little bit less than that. From what I was keeping track of, I'm doing about 25% around from my Excel, closing out at about 25% profit. But anyways, guys, I hope that answers everybody's questions, makes things a little bit more clear about the watch list and about how to allocate the cash into a balanced portfolio. So guys, hit me up on the Discord if you have any questions. Remember to put your email address in at prostockadvice.com, because you're going to get the daily notifications for the Journey to $1 Million write-up. And also, please go ahead and smash that like button on YouTube and subscribe. I've almost got 1,000 subscribers, and I really need to hit the 1,000 subscribers. The sooner the better, so I can start doing more interesting things on YouTube. All right, guys, see you on the other side. Peace.